Now I'm going to be moving swiftly along to introduce our next speaker, Henry Ward. He is a markets expert who is currently working at eToro, interestingly, one of the companies at level 39, so it all comes full circle. He's had 10 years of experience, and he provides consultation to people who might be taking some of their first steps towards investing in the financial markets. So could there possibly be a better person to talk a little bit about the financial markets to you today, answer some questions, hopefully cover any topics that you might be interested in hearing about? Please welcome Henry Ward. Hi, Henry. Thank you for being here. How are you?
Not too bad, not too bad. You can probably see a little bit of my balcony there at the side. So it's been a beautiful day today. So can't complain. How are you today?
Yeah, we're very lucky. Yeah, same. I've got this, basically the sun still here, even though it's right into the evening. So I'm definitely enjoying this better weather.
It's just nice to hear you're speaking to Amy. Is like when I want rooms for my events in level 29 or level 39, I go to Amy, and she's the one who sorts it out for me as well. So
it's right full circle. It's a small world.
It's a small world. Yes,
it is, isn't it? All right. Well, I mean, I'd love to get started talking about the markets, as I'm sure people are interested. It's a crazy time in the markets right now. So before I start talking about any market specifics, I guess, everything, like every second the news changes. Every second there's something happening somewhere, in China, in Hong Kong, in America, something's changing. Where should people go if they feel like every time they blink, they've missed something? What resources do you use? How would you suggest people stay on top of the economy in general, as well as the financial markets?
Well, as you know, the world is very broad. So the easiest way to do anything is actually stay at home. Okay, work from home. So there's no point in looking to trade the Chinese market if you know nothing about it, if you've never been to China and any of that, because you're speculating on markets you know absolutely nothing about. So the best way to start is at home. So one of the things I say to people about investing is you have the likes of the FTSE 100 there. And people are always asking me, Henry, what stocks should we look at? And the first piece of advice I give to anyone is get the full list of FTSE 100 companies, which is very easily Googled. And then for each one, go down through each one of a Sunday when you're doing nothing, because at the minute lockdown, no one is doing anything. So, and go through them all. And what you do is you look out which is trending up, which is trending down. And if there's anything moving sideways, you just put it in the bin. Okay, so that means you're whittling down the which ones are good. Now, the idea is to try find the ones that are trending up, because you will, one, make money as the stock grows, but two, if it's a dividend company, you can potentially make money from the dividend as well. So you're looking to get paid twofold on that one, whereas on the downside, you don't. And also on the downside, you're trading a CFD rather than the physical stock. So they're generally the two ways that you can actually trade them. So, but the idea is to set yourself up, because at the end of the day, if you fail to prepare to fail.
Yeah, I like that. I might get that tattooed somewhere. So you mentioned that there's two ways to trade, and one of them is a CFD. So for the people who might be a little bit less familiar, quickly, could you just go through what that means?
You say quickly.
Okay, I'm sorry. As quickly as possible.
I run courses on this, and people still don't get it at the end of the day. So basically, what a CFD, you have to go back a little further. It's So what is, you're taking out a contract speculating on the market, but you don't physically own the stock. And what you're doing is you're saying the market is here and you're expecting it to drop down. And as it drops down, you are making money because you placed a sell order on this. And that's effectively what a contract is. But you are subject to fees, which means, and that's the problem with a contract, is that any contract you ever take out, you have to pay some sort of fees, whether it's finance on a car, whether it's a watch, whether it's your credit card. They're all contract differences. They're a different type of contract, but you pay fees on it. And trading is the very, very same. So when you're shorting the market, there are fees. Now, if you're buying the market with the likes of eToro, eToro are commission free, which means then that there's no fees as the market's going up, and we don't charge people spread when we get into the markets. So which means then buying a stock is an all-round just a better idea. But there are some huge opportunities when the market is dropping. Up to a week ago, Aston Martin was dropping like a stone. So that was a great opportunity for a short.
Okay, great. So I guess it works out to bet on something or against something. Either you like it or you don't like it.
So you're speculating that the markets are going to go down, or you're physically buying the stock. Now you can also trade a CFD long as well, but most people don't because they want to sit on the stock, hold it long term, and let it run. Whereas if you're buying the currency market, there's no physical currency on the platform, so which means then you have to trade them on the likes of a CFD. But there's loads of opportunity out there at the market at the minute, and just it's whether people have the knowledge to actually monetize what's going on or not. And that's down to the simplicity of it at the minute.
No, that's fair enough. And you mentioned earlier that it's important to stay home when you're, considering the economy. Stick with what you know.
Save the NHS.
Right, exactly. Save the NHS and stick with what you know. So what about the situations where what's happening abroad might impact what's happening at home? Like, to what extent should we stay up to date with news that might impact us indirectly, even if we're not directly trading in, Chinese stock? Should we still be keeping up to date with what might be happening over there, or should we just totally blinders what's happening in the FTSE 100?
Well, see, the thing about it is that you're looking at a broader market. That then comes down to what type of a trader are you? If you're an entry day trader, that really has no effect on you. So what an entry day trader is someone who will get in and out sometime within an hour or two in the markets, make some money and get out. That's an entry day trader. Now, if you're an end of day trader, you will hold on to your trades a little bit longer, which means then that outside factors, by the time they happen, they can potentially affect your trade. But then again, if you're a long-term trader where you're looking to hold on to trades for 5-10 years, they have no impact on you. So the biggest sort of impact is as a day trader there. That's when you have to start looking at outside influences. You have to have a look. You have to make sure the economic calendar has no major news coming out. You have to start looking into, and you have to start following Donald Trump on Twitter, because nowadays that's how people release news announcements, is on Twitter. Who knew?
Right.
But there's algorithms out there that will have actually linked to Donald Trump's Twitter, and will all of a sudden, if something comes out that they deem negative, that they're already into the market, which means by the time you see it, by the time you react, the market has already dropped.
Yeah, I did hear that actually Trump's tweets are correlated with drops in the market, which is just kind of an interesting idea to think about. Technology is bringing us in interesting directions.
It's funny because I end up was watching Bloomberg, and they just stopped what they were doing and goes, "Oh, Donald Trump has just tweeted that there's 10,000 barrel reduction on." All of a sudden, I myself jumped into oil, took it long, took a winning trade out, and then jumped out. And then about a week and a half, about 2 or 3 days later, then it dropped down again to where it originally was. So it's little things like that. So these are things that novice traders don't know about. But the problem is that you do not trade the news till you become a seasoned trader. That is the problem, because what happens with news is generally there's a spike one way and then it spikes the other, which means that you've been triggered in and then triggered out, and you end up losing your money. And that's the problem with trading the likes of news. Now, if you have something the likes of, for instance, McDonald's last year, right? The CEO got sacked for doing stuff he shouldn't have been doing. And that was the only reason he got sacked. And the silly thing about it is that the share price didn't change, the earnings didn't change, anything didn't change, and all of a sudden the stock actually plummeted. It came down to a really nice level. Now, when I looked into it, the only thing that had changed was the CEO, and the new person they were bringing in. I had a quick look at it. Anytime he jumped into a company, they have progressed on, and then it was very, very simple then to jump into McDonald's and take a trade long, and was in that there till March there, when the coronavirus tipped off, and then I jumped out of that trade in most of my positions, except two, Apple and Microsoft.
Okay. Huh. So I guess, yeah, you got to be careful when you're a novice to look out for the details that you might not be thinking of looking out for.
But the easiest way for a novice to trade would just be literally long term, is to buy something with the goal in your head that this is long term and forget about it, and then come back and buy some more, forget about it, come back, buy some more, forget about it. But in between that, you're doing some education, whether it's the free trading course on eToro, or whether it's you're just watching YouTube or whatever, and get some education while you're doing this, because the idea is if you buy the underlying stock and you hold on to it, stocks are generally designed to go up, because what's the stock's only goal is to generate more revenue. Next year, more revenue, more revenue, more revenue. And if that drops, then the stock will depreciate. But the idea is that if you get sound stocks like the FANGs, the top 5 companies out there, the likes of Facebooks, the Apples, the Amazons of the world, they should continually go on, because the demand for them is getting higher and higher and higher.
Yeah, I suppose for a lot of people, it's more difficult to look in the long term, given where we are and given the situation that they see. You know, they're seeing all these shops closed. They're seeing people losing their jobs in America. Tens of millions of people are just all of a sudden out of a job because of the situation. So I suppose they see that and they think, well, I guess everything just must be tanking. It's just game over all over the place. But actually, that's not what we're seeing, right? We're actually in the middle of a rally. Correct me if I'm wrong. So for people who are just feeling like what I'm so confused about what the market is basing itself off of, where are the connections, where are the links, which part is the actual economy that matters to me, what should a novice trader do when they're struggling to find some clarity?
Okay, so rather than answer that question, I'm going to sort of interview you now a little bit. So have you ever traded before?
No, I don't. Personally.
Okay, so investing in airlines, would that be a good investment at the moment?
No.
Yes or no?
I
Perfect.
wouldn't, no.
Investing in some sort of tech at the minute, would that be a good investment?
I would say yes, but I'm also in
Perfect.
fintech.
Well, but the problem is that people don't put that logic into the market. Okay, so first and foremost is that travel, airlines, stuff like that there has just depreciated, massively dropped down. Something that has taken off is tech. You have Netflix, you have Zoom, you have Apple, you have Shopify, you have all these tech companies that have just risen massively. Why? Because they're relied on throughout this pandemic. Okay, and it just shows the reliance we have on tech, and that's something that has grown exponentially. Whereas people will just jump out of the market and go, "Oh, I'll just hold on to my money. It's safe. It's stuff like this." But for me, when we had that pullback in coronavirus, I was loving it, because I wasn't in a position in the crash in 2008 to be able to avail of that. I've now seen this crash, and I'm looking at it going, thank God. Thank God. Why? Because I'm now able to start buying up the stocks again. I'm now able to buy stuff at a massively cheap. So you have the likes of Apple. Apple, it was $1 trillion company, was at a record high, and then it dropped 40%. Now, do I think Apple will reach that height again? Absolutely. Why? Because the demand on their product is huge. So now I'm getting a blue chip company that is top of the range at a 40% discount. Does that make sense?
Yeah.
Whereas if you ever hear Warren Buffett talking or watch any or read any of these books, you never followed scared money. And what happens with scared money is people pulled out of the market. Whereas me as an investor, I'm looking going, oh, this is brilliant. This is brilliant. We'll come down a little bit further, and then I'm in with my positions. And that's the and the problem is that you will never ever catch the bottom. So some of my positions did go down, but as it turned, it hit the bottom. Like you said, we're now in the middle of a bull run. Now that bull run is sort of a false bull run, because we have the quantitative easing that's after happening. Now, what quantitative easing is the governments have bought up bonds to get the market stimulated again, to get everything moving, the economy moving, which means then that this is not a real bull run. It's more from quantitative easing. Now, as you see, we talk about Warren Buffett there. and his company is Berkshire Hathaway, and they are sitting on billions of pounds at the minute. They haven't jumped into the market yet. And
Mm-hmm.
the reason they haven't jumped in yet is because it's one of these false runs. But if it continues going the way it is you will start seeing all the rest of the money that's been sitting on the sidelines jump in. Why? Because we're now almost at record highs. The Nasdaq is literally 1 or 2% away from the record high at the moment.
Well,
So it's literally after recovering.
mm-hmm. So I guess the volatility shouldn't scare people off. They should just have their strategy and stick to it.
Oh, absolutely. That is absolutely key, is that you have a strategy and then you sit through it. It's as like I say, unfortunately, 10 years ago, well, when in 2008, when the last credit crunch happened, I was a qualified carpenter. I was putting roofs on houses. And from that point, buildings stopped, economy stopped. We went into recession and I had no work. Now it really makes no difference to me whether I'm working or not. Why? Because I can make some money out of the markets and trade them. And the idea is once that all drop down to a low, just buy it up. Absolutely. Buy and invest as much into companies that are trending nicely, but have retraced down. Where the likes of, we talked about the airline industry. A lot of those airline industries are being in a downtrend for the last 2 or 3 years anyway. So they are not the likes of the charts that people should look at as the likes of MasterCard, which has been rocketing up. And then because of coronavirus had a drop of about 60%. And now look, it's starting to go up again. And once you start seeing the shoots of growth, of new business coming in, that's where we're looking to jump in on. And that was to just give one example of a chart, yes. And just to give you a heads up, that's not a tip. That's just a little bit of advice.
Okay. Well, I'm sure people love advice. I'm sure a lot of students are considering. I get a lot of friends who ask me, should I trade? Like, I'm wondering, is it smart? Am I going to get scammed out of all my money? So I guess, for people who still have some doubts about, is it really gambling? I'm sure you get that question a lot. Like, is it gambling? Is it just a casino? What would you say to that?
But people ask me about gambling all the time. If you ever speak to a rich person, how many revenue streams do they have?
Many, I'm sure.
Okay. How many revenue streams do most people have?
The one.
One. Okay. Absolutely. So the problem is that you're speaking to people who have one revenue stream. So once you speak to the millionaires, people who have money, people who've amassed wealth, they will say to you that you have to speculate to accumulate. Now, when we say that, we don't mean that you go on and you put all your money into all your eggs in one basket. As people always ask me, Henry, is it gambling? Is it this, all this sort of stuff? Now, the answer to that is it depends on you. So if you have 10 grand sitting at home under your mattress or in the bank doing absolutely nothing, and people say to me, oh, Henry, I have 10 grand, I could put that in. And I go, is that your life savings? And I'll say, yes, it is. Well, then take that 10 grand out of your trading account and put it back in your bank account. Leave that there. You should leave that there because that's your nest egg. That's your rainy day fund. Now, what I recommend the people to actually do is that at the end of every month, we have a little bit of money left over. Now, that little bit of money, just imagine it's 500 quid. Divide it in half and use 250 for whatever you want. And then the other 250 goes into your trading account. Now, you were going to spend it anyway. That wasn't going to go into savings. That was going to be on nights out, shots, whatever it was that people do, wherever they spend their money. It's going to go on whatever it is. But chop it in half and then put the other half into something. And the easiest way to trade is buy up some stocks and just let them run, let them go. And all of a sudden, over a long period of time, you then grow huge amounts of stocks there, even though you weren't trying to. Does that make sense? And that's the simplest way to trade. And you still have your rainy day fund if the roof starts leaking or you have to go away on holiday or something happens like the coronavirus and you have to pay rent. You still have that money there. And you're not going near your stock portfolio. And that's the problem. And but people don't trade from logic. They go, I have 10 grand. How do I turn it into $1 million?
Right.
And that's not how anyone should trade. You're watching too much Facebook, too much Instagram, stuff like that. You're watching all these ads of people standing beside Lamborghinis that are rented.
Wow. Isn't that an allegory? I'm sure. Yeah, I see. So I guess what you're saying is don't make that your last resort. Don't be like, oh, all of my eggs need to go in this basket and fingers crossed it pulls through so I don't like I can pay the rent this month.
Absolutely. You put
Hmm.
money aside that you can afford to lose, that you don't need, that there's no want for it, that you can go and pull that out in 5 or 6 years' time if you want.
Hmm.
You can let that run. There doesn't have to be an end date on that. But what happens, people put in their money and go, oh, I can leave that in the market for 2 or 3 months. But just imagine you put your money in the market in February or March. We then had this big drop down, but you had to pull your money out at the end of March. You would have been massively down on your 10 grand.
Hmm.
Now, if you would have jumped in at the bottom of March, now you'd probably have doubled your money by now. Does that make sense?
Yeah.
And there's nothing in between. Whereas what I'm showing you is that the in between bit, you can survive as it's going down because you don't need that money. And as it goes back up, perfect. And you're now at the minute where the top prices are the stocks that you get into top are now in money. The stuff at the middle are in money. The stuff at the bottom are in money. And that's the idea, is to grow it. Dollar cost averaging is actually is the correct name for it. So anyone who doesn't know how to use that there, just Google that strategy. It'll come up. The idea is that you invest in some stocks once a month or once a week or once every 2 months. But it doesn't matter where the price is. You just invest at that specific time, the same amount of money every month.
Hmm. Okay. Well, like savings, I guess, or like retirement.
That's
Put it
the
right away.
idea, is that you're saving for your retirement. It's literally a savings account.
Hmm.
Now, I say to people, I can show you how to potentially make money over 10, 20 years. People go, really? That long? And the idea is yes. And then once I show you other techniques and get your skill set better, then you can drag it back. You can pull it back. You can pull it back, and then you go from there. But it's all about you educating yourself.
Hmm.
So everyone in UCL, they're in uni, and they're potentially doing between 2 to 4 year courses
Hmm.
to get into a job, into an area where they want to work. But the problem is people put 500 quid into a trading account and expect to double it or quadruple it in a month. But you've never done any education. And
Hmm.
that's what I don't understand. And for me, there should massively, massively be some sort of curriculum in school, in secondary school, for people, money management. Massively.
Hmm. Yeah, well, hopefully we'll be picking up the slack as UCL FinTech Society and helping people get that education as well from our end. We'll do what we can. But you've definitely spoken a lot about stocks specifically. I'm kind of curious, you think stocks in specific over gold, over crypto? Let me pick your brain a little bit about that.
Well, the thing about gold is gold has always been the safe haven against the US dollar.
Hmm.
So back years ago, what they did is they printed enough money, and then they got the physical gold and put it into Fort Knox and put it there. So that means then they had the same amount of money in circulation as gold. So gold was the reserve. Now, as time gone by, there's been more and more money printed, the likes of quantitative easing, so on and so forth. So some people say it's diluting the value of actually the fiat, but some won't. Then you have the likes of gold, which is a finite resource. And the thing is that it peaks and troughs. There's massive waves in it. When US dollar is under pressure and weak, gold gets stronger. When US dollar is stronger, gold gets weaker. So they have the divergence effect, so that they go in the opposite directions. And
Hmm.
that's something that people sort of don't understand. And then you have the emergence of the cryptocurrencies. So the cryptocurrencies were a massive way of actually working out and finding another income stream, another way of getting in here. Now, I'm someone who's a big advocate for technology, and some of the technologies on the blockchain and Bitcoin and XRP and the all, there's huge, brilliant technology there. Now, will any of those be the digital currency that we go into? Who knows?
Hmm.
Probably not. We'll probably end up having some sort of cryptocurrency that's much easier to use, much faster transactions, and just much more streamlined. But remember, these are guys that are opening the door for the likes of them to come through. So at the minute, yes, there's loads of opportunity in the markets. And we had the Bitcoin halving that came up there last
Hmm.
month. and you know what I mean. There was huge anticipation, and then nothing really happened.
All right. So I guess for novice traders, keep their ears to the wall, I guess, and keep an eye on everything where they can.
But the thing about it is that you sort of have to pick an area that you want to go into.
Okay.
Do I think gold at the present moment is overvalued? Massively, yes.
Mm-hmm.
But remember, with you just said it, with the unemployment rate in the US soaring, stuff like that, there people are pushing their money into safe havens, which is gold and silver. Now, we were actually expecting a lot more of people doing that with the likes of crypto assets, but it hasn't happened as much. We were expecting with the likes of the Bitcoin halving, with the dollar getting stronger, we were expecting a little push to the upside, and Bitcoin is failing to break that 10,000 mark.
Mm-hmm.
Now, if you're an avid of technical analysis, there's a triangle setting up there now as well, and that's a huge way of actually trading the crypto market is using triangles, and there's a big one there. And for me, looking at it now, the longer it stays at that 10,000 mark, the more pressure it is to the downside. But we'll see. Only time will tell. If a whale comes in with some money, then all of a sudden Bitcoin rallies and drives to the upside.
Mm-hmm.
And the same to the opposite. If a whale comes in and drives the market down, then it will continually go down, because the likes of the crypto assets is literally down to supply and demand. Whereas we see with the stocks and we saw with the currencies is they are manipulated by governments and by banks and by people. Why? To try and keep things affordable for people.
Mm-hmm. Yeah, and I suppose along those lines, if I had to ask one final question as we prepare to move on to the next speaker, I guess the question would be, do you think when people are considering now that a lot less people have jobs, career outlooks are looking a little bit shakier, do you think when people are looking at their last, little bit of money left at the month, it's definitely worth it to put that into stocks and trading, would you say?
Look, if you've lost your job and that's the last bit of money you have much better uses for it than trading.
Mm-hmm.
So if that's the last bit of money you have, or your last little bit of investments, and your job's uncertain, I would not suggest anyone put that into trading, because that's needed for your rainy day. But if you have a job that's pretty secure and you are carrying on, but you're in that rut, you're in that mundane, that you literally have a small bit of money left over at the end of each month, stuff like that there, the idea would be then is to educate yourself on potentially trading or another way of generating a secondary revenue stream. And once that second revenue stream comes, then you slowly can start taking money from each revenue stream and go, okay, well, now I have two incomes coming in. Potentially, how do I push on to have a third where I'm not in a position like this anymore? And then potentially the money that you're making from the likes of stocks or FX or indices or crypto or ETFs for that matter, then you can potentially take that out and fund a business. And then when the business up and running, then get back and start trading and building your stock portfolio again, and investments, whether they're ETFs, whether they're buying solid cryptocurrencies or the real crypto, or whether it's buying the underlying asset with the stocks. It's the problem is that, like you said there, your last bit of money, your job's uncertainty, that's when people try get into trading from fear because they have no other option. But that's the opposite to where we should be getting into trading. We should be getting into trading when we have a little bit of disposable income, that you don't need that you can actually trade. Okay, so, and that's where we should be coming from.
Okay, so if that had to be your final takeaway here, as we have 1 or 2 minutes left, would you say that it's be careful and educate yourself and don't put all your money anywhere?
But that's it. That's at the end of the day is the one thing that massively lets people down everywhere. It's not just here in Britain. Is that we need more than one revenue stream. Everyone needs that. They need 2 or 3 or 4 revenue streams. But the problem is that people are so focused on their job and relationships and life and stuff like that there, that they get comfortable. As people, human beings, we get comfortable. We follow routines. So then you get into a routine and you start living within your means. And the problem is that people need to then have a little more drive, a little more, what would you call it, business mind, and then to start generating a second income, whether it's through business, whether it's through currencies, whether it's getting a second job, whether it's through trading the markets. And that's what we should be looking to do. So everyone should absolutely educate themselves, because that is number one, the biggest reason people lose money in the markets. That's it there. That, you know what I mean, education is key. Know your audience and make sure that you know what you're trading. And once you know what you're trading, then you can kick on from there. And trading is not hard.
Mm-hmm.
The psychology behind it is the hardest part. So trading is not hard. Psychology is that your trade is now losing, then it's winning, it's losing, it's winning. And then, oh, do I jump out? Do I stay in it? And that's it. That's the hardest part, because we're so emotionally attached to our money. So
Mm-hmm.
yes, education is key. And then when you have your education done, then start investing.
Great. So I guess with that, thank you very much, Henry Ward, for giving us some insight, a little bit about the markets, a little bit about the macro as well. So I guess I'm just going to thank you very much, and then hopefully we'll see more of you at UCL Fintech during this upcoming year.
It's been an absolute pleasure, and I'm sure to be back. Yes.
Thank you so much.